Good morning, everyone, and welcome back to our channel. Thanks so much for tuning in this week. This week, we're going to talk about step number 6 of our 10 steps to buying a great home in Central Maryland. And the topic for this week is we're going to talk about locking down your financing. And what we mean by locking down your financing means getting the lender to officially commit to giving you a loan for your new home. So in our last video, we talked about doing your due diligence for the home that you're going to buy. So like your home inspection and any other inspections that you'd like to have completed. So if you guys missed last week's video, that's okay. Take a look back at our channel and also hit that subscribe button so that you know every week when our new video comes out. So now, once we go under contract for your new home, your lender is now going to get heavily involved. So as your realtor, we are still involved in coordinating things and making sure that deadlines are met and that things are generally moving forward. Your lender now gets the opportunity to pick up the ball and make things happen because now we actually have to secure the financing that you're going to use. You see, in step number 2 from a few weeks ago, we talked about getting pre-approval for financing. So that was where the lender takes a good look at your credit, your income, your debt, and they say that yes, they will lend to you, and they are okay with lending you up to a certain amount of money. Now, once we are actually under contract, the lender now has to go through their process to make sure that you meet their lending guidelines and to actually secure that mortgage for you. Now, most of the time, your lender is going to ask you for more documents. Things like bank statements, pay stubs. Perhaps they may need you to write a letter explaining some type of extenuating circumstance or event on your credit report, all of those things like that. Now, they apologize for it. Unfortunately, it's part of the process, but for your lender, they need to make sure that you, the borrower, meet what they call their lending requirements. We're going to talk about why in just a few minutes, but just a thing to remember, we talked about in step number 2 that lenders are not in the business of lending money to people that can't pay it back. All right, they want to make sure that if they give you a loan that you indeed could pay it back. So depending on the type of loan that you're approved for, they are going to be putting things together to submit to various different departments and agencies. For example, if you are approved using something called the Maryland Mortgage Program, which is a great program here in Maryland, they have to get all of the required paperwork together in order to show the Maryland Mortgage Program that you qualify for one of their loans. The lender also is going to ensure that the property is worth what they're going to lend for it. They do this by ordering something called an appraisal for the property, and you've probably heard that term before. So now let's talk a little bit about appraisals and kind of what they are. So as a buyer, an appraisal is useful to you to know what the bank values your property at. An appraisal is done by somebody called an appraiser. All right, they are people who are specially trained to look at properties and all of the comparable properties that have been sold recently in that area and determine an actual value for the property. Appraisers are licensed by the state of Maryland and they are regulated. So not just any John Doe off the street can hang up a shingle and say that they're an appraiser. They have a whole process of education that they have to go through. So it's something that has to be done in the correct way. Typically, the appraisal occurs approximately 2 weeks or so after we go under contract, and there's a reason for that. The appraisal usually costs about $500, and we want to make sure that before you spend money for an appraisal, we want to make sure that we're a little more certain that you're going through with the purchase. So that's typically why we wait until after the home inspection to get the appraiser to come out. Now, generally, the buyer is not present for the appraisal. However, you will get a copy of the appraisal once it's complete. During the actual appraisal, the appraiser is going to come out. They're going to walk the entire home. They're going to take measurements of each room. They're going to take photos, and they're going to sketch the layout of the home. They're also going to do a visual inspection to ensure that the property meets the particular loan program requirements and their minimum property standards. And yes, there is something called minimum property standards. And what that means is that for certain government-backed loans, things like FHA, VA, USDA loans, the government has regulations that require you to purchase a safe home that's free from any major health and safety hazards. Typically, the most common ones that we find are things like chipping and peeling paint or missing handrails on elevations greater than 30 inches, something where somebody could potentially fall. Once they are done with the visit to the home, then they go back to their office and they're going to get busy doing their work. Now, they're going to look at property values and look at the comps and determine where the value for your property should be. Now, the listing agent will typically give the appraiser a list of the comparable properties that they used when they came up with the property. Okay, and that's really important to know that, as a realtor, we don't just come up with these off the top of our head. We actually have evidence for the pricing that we do. They also generally will give them a list if there have been any upgrades to the property that have been done or anything like that, so that the appraiser knows. If we have done our job correctly, then the appraisal is going to come back either at contract value, which means the house is worth what you're going to pay for it, or even a little bit above it, which would mean that potentially you're going into the property with a little bit of equity. Now, let's say your appraisal comes back a little bit low. What happens then? Well, then we're going to let the listing agent know that, hey, the appraisal came back low, and the seller is going to have a choice to make here. They can do one of two things. They can ask you to either make up the difference in cash, which means you would have to bring some more cash to the table, or they can lower the price down to the appraised value. As your agent, we are heavily involved here because we want to make sure that this ends up as a win-win for everybody. So we really want to make sure that everything that we do helps you guys out so that you can secure your new home here. Once we have figured all of this out and we've narrowed down the value and we figured out what everybody wants to do, we'll get all the paperwork signed, and the lender is going to finish up processing the file. They're going to put a nice bow on your file, and they're going to move it over to something called underwriting. So underwriting, what is that? Great question. We knew you wanted to know this. So at each lending institution, they have people called underwriters. And these underwriters are tasked with looking at your entire lending file and making sure that all of your I's are dotted, all your T's are crossed, and that everything is good and that you meet their bank's lending standards. They've never seen your file before. They don't know you, so they really take an unbiased look at the file. Now, most of the time, this is a 24 to 48 hour process. And our goal is that we get something called loan commitment or conditional loan approval once the file comes out of underwriting. And what that means is that the bank is going to approve your loan as long as a few conditions are met. And those conditions usually are things like they need to see some paperwork, maybe the appraisal isn't back yet. So they want to make sure that these things come back for value. Now, one thing to note here about loan commitment, which is super important. Just because we have loan commitment, that does not mean that you as a buyer can go out and start buying furniture or putting things on your credit, okay? Please keep in mind, your lender is going to re-pull your credit again within 48 hours of closing. So just keep up the good work. You've made it this far. We're going to maintain that pre-approval just a little while longer all the way through closing, okay? Super, super important. Depending on the efficiency of the lender, it is actually not unheard of right now to have a loan go through underwriting prior to the appraisal coming back, or even prior to going under contract for a property. Okay, that essentially you've gone through underwriting, and the condition that they sent back is that they need to see a purchase contract for a property. So once we have loan commitment from a lender, we're now coming down the home stretch, and we're headed for home. But wait, there's still more, right? We're only on step 6. We have 4 more steps to go. So tune in next week when we talk about step number 7, and that's going to be talking about other contingencies and insurance, which is super important. Until then, I'm Jeremy, and thanks for tuning in to step number 6, talking about securing your mortgage. Now, if you're ready to get started on that path to home ownership, hey, let us know. Please reach out. Our information is down below here. So reach out. We'd love to schedule a personalized consult with you to help you get on this road as well. Thanks so much for tuning in. We'll see you guys next week.